Friends, thank you for being here today. We stand today, specifically on December 11th, 2025, at a moment that historians will likely record as the financial event horizon. Yesterday, the world celebrated what looked like a victory for sound money advocates. The price of silver broke free from decades of commercial suppression, surging past psychological barriers to reach an all-time high of $62.30. On paper, anyone holding silver is richer than they have ever been. The charts look magnificent, a vertical ascent that promises wealth and vindication. But today, the celebration has turned into a bewildered silence. The phone lines at the world's major bullion dealers have gone dead. The websites of the largest distributors are displaying maintenance errors or out-of-stock banners. We are witnessing a phenomenon that defies the basic tenets of Economics 101. The price has skyrocketed, yet the supply has vanished. This is not a standard supply shortage where demand slightly outpaces production. This is a liquidity nightmare. The supply chain for physical silver has not just stretched. It has snapped. From the refineries in Switzerland to the mints in Australia, and down to the wholesalers in North America, the gears of the industry have ground to a halt. We are seeing a market that has gone bid only. There are millions of buyers waving cash, desperate to exchange depreciating fiat currency for hard assets, but there are no sellers. The sellers have left the building. To understand why a price of $62.30 has resulted in a total market freeze rather than a flood of new inventory, we must peel back the layers of a complex, leverage-filled financial system that was never designed to handle this level of volatility. We must look into the refiner's trap, the wholesaler's insolvency, and the inevitable industrial panic that is currently unfolding behind closed doors. Let us first examine the phenomenon that defines this crisis, the bid-only market. The current situation on the ground defines a paradox. In a functioning market, higher prices act as a signal to producers and holders of an asset to bring more of that asset to market. If the price of corn doubles, farmers plant more corn. If the price of a stock rises, existing shareholders might sell to take profits. This liquidity, the matching of buyers and sellers, is the lifeblood of any market. However, silver is not a standard commodity. It is a monetary metal wrapped in layers of paper leverage. As of this morning, that leverage has turned toxic. We are witnessing a disconnect between price and availability that is absolute. The spot price holding the line at $62.30 suggests a robust market. Yet, try to take that $62.30 and purchase a physical ounce of silver. It is an impossible task. If you call the major refineries, you will hear a dial tone or a recorded message stating that due to extreme market volatility, new orders are suspended. This is the definition of a broken market. The ask side of the order book has evaporated. The reason for this freeze at the retail and wholesale level is a concept known as replacement risk. Imagine you are a major bullion dealer. You have a warehouse full of monster boxes of silver, eagles that you purchased 3 months ago when the price of silver was $30 an ounce. Today, with the price at $62.30, you could theoretically sell that inventory and realize a massive profit. A standard business model would dictate that you sell high. However, bullion dealers are not speculators. They are flow businesses. They need to replenish their inventory constantly to stay in business. If a dealer sells a box of silver today for $62 an ounce, they receive cash. But to stay open tomorrow, they must take that cash and buy new inventory. Here is the trap. If the price is rising exponentially, jumping from $62 to $70 to $1.80 in a matter of days, the cash they received from today's sale will not be enough to buy back the same amount of metal tomorrow. They would be selling an appreciating asset for a crashing currency, effectively liquidating their own business capital. Consequently, the smart dealers, the veterans who survived the volatility of 1980 and 2011, have realized the danger. They have ceased all sales. They are hoarding their own inventory. The metal exists. It is sitting in vaults and safes across the country. But it has transitioned from inventory meant for sale into strategic reserve meant for survival. This has created a liquidity vacuum where the metal is physically present but economically inaccessible. To truly understand why the supply chain snapped at $62.30, we must look upstream to the technical cause, the refiner's trap. To truly understand why the supply chain snapped at $62.30, we must look upstream to the refineries. These are the entities that turn raw ore into investment-grade bars. Most investors assume refiners love high prices, thinking that a higher price means more profit. This is a misconception. Refiners hate volatility. Their business model is built on stability and volume, not price speculation. A refinery operates on a delta-neutral basis. When they buy 1 million ounces of raw ore bars from a mine, they possess physical silver. However, it takes time, weeks or even a month, to refine that silver into pure 999 fine bars. During that time, the price of silver could drop, which would cause the refinery to lose millions on the inventory they hold. To protect themselves, they use the futures market. The moment they buy the physical ore, they go on to the COMEX commodities exchange and short an equivalent amount of paper silver. This creates a perfect hedge. If the price of silver drops, they lose money on the physical metal, but make money on the short paper position. If the price rises, they make money on the physical, but lose money on the short position. The net result is zero exposure to price movement, allowing them to profit solely from the refining fee. This mechanism works perfectly in a stable market. It even works in a market with moderate volatility. But it catastrophic fails during a parabolic spike. When silver shot up to $62.30, the refiners' short positions on the COMEX began losing massive amounts of money, hundreds of millions of dollars in real time. The exchange requires these losses to be covered immediately with cash margin calls. Here lies the liquidity crunch. The refinery is technically solvent because they hold the physical silver that has gained value. However, that silver is sitting in a furnace or a chemical bath. It is a liquid. It cannot be used to pay a margin call. The exchange demands cash, not unrefined ore. When the price ripped through $60, every major refinery received a margin call they could not easily meet. They were faced with a liquidity crisis of epic proportions. To stop the bleeding, their only option was to stop entering new hedges. If they cannot hedge, they cannot buy raw ore without exposing themselves to massive price risk. Therefore, they stopped buying ore. When they stopped buying ore, they stopped producing bars. The high price blew up the very hedging mechanism that allows the supply chain to function, leading to a global production freeze right at the moment of peak demand. The freezing of the refineries has sent a shockwave down the supply chain, triggering downstream consequences and inevitable industrial panic. The freezing of the refineries has sent a shockwave down the supply chain, resulting in immediate fallout for wholesalers and retail buyers. The bullion industry largely runs on a just-in-time inventory model. When a retail customer buys from a website, the dealer often turns around and orders that metal from a wholesaler, who in turn orders it from a refiner. With the refiners paralyzed, the chain has broken. Wholesalers are now finding themselves in a state of technical bankruptcy regarding inventory. They have taken orders in cash from retail customers for millions of ounces of silver that they simply cannot source. This is leading to the mass cancellation of orders. Customers are receiving emails stating that their orders have been refunded, returning their depreciating fiat currency to them, or that their shipments are delayed indefinitely. With estimates pushing into 2026, those pre-order buttons seen on dealer websites are effectively unsecured loans from the customer to the dealer, with no guarantee of metal delivery. However, while the retail sector suffers from FOMO, fear of missing out, the industrial sector is gripped by a far more primal emotion, FODO, fear of dying out. Retail investors buy silver to protect their wealth. Industrial users buy silver to keep their businesses alive. Companies like Tesla, Samsung, and First Solar rely on silver for their products. A solar panel cannot function without silver paste. An electric vehicle requires silver for its electronics. For these industrial giants, a shortage of silver is an existential threat. If a solar panel factory runs out of silver, the assembly lines stop, billions in capital investments sit idle. Workers are sent home, and contracts with governments are breached. The procurement managers at these companies are not looking at the spot price and waiting for a dip. They are in a state of panic. Because their need is existential, they are price insensitive. They are currently offering premiums well above the spot price, paying $65, $75, or even more for immediate delivery. This aggressive bidding war by industrial giants is sucking the remaining liquidity out of the market. The retail investor looking to buy a few coins is now competing directly with Elon Musk and the global solar industry. In such a contest, the retail investor loses. The inventory that was meant for coin production is being diverted to melt pots to feed the insatiable hunger of the industrial assembly lines. I want to pause here and ask you a serious question. Given this industrial panic and the breakdown of the supply chain I just described, do you believe we have crossed the point of no return, or is this just a temporary squeeze? Let me know your thoughts in the comments below. I want to see where the community stands on this. As the physical shortage intensifies, we must also confront the emerging legal risks and the dangerous price divergence. As the physical shortage intensifies, the financial system is beginning to deploy its legal shields. The phrase that every investor needs to learn immediately is force majeure. This is a clause in contract law that frees a party from liability or obligation when an extraordinary event or circumstance beyond their control occurs. Usually reserved for wars or acts of God, extreme market volatility and market dislocation are often buried in the fine print of bullion dealer user agreements and futures exchange rulebooks. With silver at $62.30 and the physical supply chain frozen, we are dangerously close to widespread force majeure declarations. The implications for the investor are severe. If you hold unallocated silver in a pool account, or if you own shares in an ETF like SLV, or if you hold a futures contract, you do not technically own silver. You own a claim on silver. If the entity holding your liability declares force majeure, they are not obligated to deliver the metal. Instead, they can settle your contract in cash. This creates a scenario of cash settlement risk. Imagine silver shoots to $100 next week, but the dealer or bank declares force majeure based on the conditions of December 11th. They could send you a check for the value of your account at the closing price of December 10th, say $61.75. You receive your fiat currency back, but the real price of silver is trading at $100 on the street. You have lost the metal, and you have lost the appreciation. This is perfectly legal under the current regulatory framework, and it highlights the immense counterparty risk inherent in paper silver. This dynamic is forcing a divorce between the spot price and the physical price. For decades, these two prices have moved in tandem, married by arbitrage. But at $62.30, they have filed for divorce. We are seeing a phenomenon known as backwardation in the physical market. Backwardation occurs when the price for immediate delivery is higher than the price for future delivery. It signals a total collapse of trust. Buyers do not trust the COMEX to deliver next month. They do not trust the refineries to reopen. They want the metal now, and they are willing to pay a massive premium for it. If the spot price is $62, but you cannot buy an ounce of physical silver for less than $80, then the real price of silver is $80. The screen is lying. The official markets are clogging up, and the true price discovery is moving to the unofficial or black market where physical possession dictates value. Beyond the legal maneuvers, we have now entered what can be described as the Unobtanium phase of the crisis. Unobtanium is a tongue-in-cheek term used by engineers for a material that is perfect for an application but impossible to get. When a critical commodity becomes unobtanium, the price does not just rise. It creates a vertical wall. We saw a preview of this with rhodium in 2020. When supply tightened for the metal used in catalytic converters, manufacturers panicked. They needed the metal to sell their cars. The price went from $2,000 to nearly $30,000, a 14x increase. The price became irrelevant. Availability was the only metric that mattered. Silver is entering this phase. The demand for silver in this phase is inelastic. This means that rising prices do not curb demand. Usually, high prices cure high prices because people stop buying. But you cannot stop buying the material that keeps your civilization running. The strategic nature of silver in electronics, energy, and medicine means that corporations must buy it at any price to maintain operations. We are likely to see the invocation of the Defense Production Act, where the military secures silver supply for missile guidance systems and other critical infrastructure, further draining the civilian market. This scramble is rewriting the supply chain in real time. We are receiving reports that tech giants are approaching mining companies directly. They are offering to finance new mine construction or expansion in exchange for guaranteed delivery of the silver produced. They are bypassing the refiners, the COMEX, and the banks entirely. This is the ultimate sign of a broken market. The consumers are going directly to the source, cutting out the middlemen who can no longer guarantee liquidity. As physical silver becomes impossible to source, capital is beginning to flow into the next best thing, creating a massive mining sector opportunity known as the miner pivot. As physical silver becomes impossible to source, capital is beginning to flow into the next best thing, the producers. This is the miner pivot. For the last decade, silver miners have been the pariahs of Wall Street, starved of capital and shorted into oblivion. But the mathematics of mining have just shifted violently in their favor. Let's look at the economics. A typical primary silver miner might have an all-in sustaining cost, AISC, of roughly $20 per ounce. This covers their labor, fuel, exploration, and taxes. When silver was at $25, they made a $5 profit per ounce. It was a grind. But with silver at $62.30, their costs remain relatively fixed at $20. Their profit margin, however, has exploded to $42.30 per ounce. That is an increase in free cash flow of over 800%. This is not a linear growth, it is exponential. When quarterly earnings are released, and these companies show more profit in 3 months than they did in the previous 10 years combined, the stock prices will react violently. We are looking at a supercycle for mining stocks. However, investors must be selective. Not all miners will participate. Companies that hedge their production selling their future silver at fixed prices of $30 or $35 will miss out on this windfall. They are locked into bad contracts. Furthermore, jurisdictional risk has never been higher. As silver becomes a strategic asset, governments in major producing nations like Mexico and Peru will look at these profits with envy. We can expect windfall profit taxes or even full-scale nationalization. The safe havens will be miners operating in stable jurisdictions like Canada, the USA, and Australia. These stocks will trade at a massive premium as capital seeks safety and leverage. We are also on the verge of a massive M&A, mergers and acquisitions wave. It won't just be miners buying miners. We will see automotive and technology companies acquiring mining stakes to secure vertical integration. Tesla buying a silver mine is no longer a wild theory. It is a strategic necessity in an unobtanium world. However, we must also prepare for the inevitable regulatory countermeasures as the empire strikes back. It would be naive to think that the establishment, the bullion banks, the exchanges, and the central banks will simply watch the system collapse without a fight. They have lost the market war, so they will now initiate the regulatory war. We are about to witness the empire strike back. We can anticipate a series of market suppression techniques designed to break the momentum of the price and force speculators out. The first tactic will be the margin nuke. The CME Group and other exchanges will likely announce emergency hikes in margin requirements. If it currently costs $10,000 to control a contract, they may raise it to $50,000 or $100,000 overnight. The goal is to force retail traders and small speculators to liquidate their positions because they cannot afford the deposit, artificially creating selling pressure. Second, we will see position limits. The CFTC, Commodity Futures Trading Commission, may declare a market emergency and place a cap on how many contracts any single entity can hold. However, history suggests they will include a loophole exempting commercial hedgers, the banks, allowing the shorts to remain while forcing the longs to sell. Third, the political narrative will shift. Politicians will appear on television labeling silver stackers as hoarders who are holding the green energy transition hostage. They may propose windfall taxes on precious metals sales, framing it as a fight against economic terrorism or price gouging. Finally, we may see the restructuring of major ETFs. Funds may suspend the creation of new baskets of shares, disconnecting the share price from the physical net asset value, NAV. This would leave passive investors trapped in a paper vehicle that does not track the exploding physical price. However, these measures are ultimately ineffective. They can kill paper demand, but they cannot print silver. In fact, these draconian measures often worsen the physical shortage. If you tax the sale of silver, people will simply hide it and stop selling, further reducing supply. If you ban speculation, price discovery moves entirely to the black market. The government can create volatility, but they cannot conjure 1.1 billion ounces of silver out of thin air to solve the deficit. To fully grasp the magnitude of this event, we must widen our lens to the geopolitical endgame: the East, the West, and the war for sovereignty. While we have focused on the mechanics of the Western exchanges, a far larger game is being played on the global chessboard, one that ensures the West's pricing monopoly is permanently broken. For decades, the silver market has been characterized by a singular, bizarre flow of capital. The West sells paper, and the East buys physical. This arbitrage, which allowed bullion banks to suppress prices via the COMEX, while the Shanghai Gold Exchange, SGE, accumulated metal, has now violently unwound. The East is no longer content to accept Western IOUs. They are demanding delivery, and the vaults in London and New York are being drained to satisfy this insatiable appetite. This is not just an economic shift. It is a matter of national security. Nations like China and Russia understand that silver is not merely a monetary metal, it is a strategic war material. You cannot build a hypersonic missile, a satellite array, or a 5G communication grid without silver. By allowing the price to remain suppressed for so long, the West effectively subsidized the military and industrial buildup of its geopolitical rivals, selling its strategic heritage for pennies on the dollar. Now, with the supply chain snapped, the West finds itself in a precarious position, dependent on a metal it no longer controls. The Shanghai Premium, where silver trades significantly higher in Shanghai than in New York, is acting as a vacuum, sucking the last remaining 1,000-ounce bars out of Western jurisdictions. The pricing power has shifted. The COMEX is becoming a regional backwater, while the SGE is setting the true global price based on physical reality. But the endgame goes even deeper than nation-state rivalry. We are standing at the precipice of the digital prison. As the dollar system buckles under the weight of its own debt and the bond market freezes, the inevitable response from Western central banks will be the rollout of central bank digital currencies, CBDCs. They will pitch this as the solution to the liquidity crisis, a frictionless, digital dollar that can be airdropped directly into your wallet. Do not be fooled. This is the ultimate control grid. A CBDC is programmable money. It can be turned off if your carbon footprint is too high, or if you buy the wrong things, or if you hold the wrong political views. In this incoming digital dystopia, physical silver becomes something far more valuable than an investment. It becomes the freedom asset. Silver is the anti-CBDC. It is private, it is peer-to-peer, and it requires no electricity or internet to function. It is the battery of the parallel economy. As the official channels become heavily regulated and surveilled, a parallel system of commerce will emerge. Indeed, it is already emerging. We are seeing communities where goods and services are traded directly for silver rounds, completely bypassing the banking system. By holding physical silver, you are not just speculating on a price rise, you are voting against the surveillance state. You are securing your ability to transact freely in an unfree world. This moral dimension is what gives the silver squeeze its unstoppable momentum. It is not just about greed. It is about liberty. Finally, despite the regulatory headwinds and geopolitical shifts, we need to map out the price roadmap and define a clear exit strategy. Despite the regulatory headwinds, the mathematical reality of the deficit points to a continued ascent. We can map out the path to $100 in 3 distinct stages. Stage 1 is the gamma squeeze, $62, $75. This is happening right now. Market makers who sold call options at $65 and $70 strikes are forced to buy futures to hedge their exposure as the price rises. This creates a self-reinforcing loop. The higher the price goes, the more they must buy, driving the price even higher. Stage 2 is the media mania, $75, $85. Once silver breaks $75, it will lead the nightly news. This will attract the general public, the herd. These are people who know nothing about market mechanics but chase momentum. Their capital, though dumb money, is massive in volume and will push prices through the $80s. Stage 3 is industrial capitulation, $85, $100. This is the final leg where industrial users stop fighting the price and start panic hoarding. They will issue corporate bonds to raise cash specifically to buy silver, grinding through the final resistance levels. At $100, we cross a psychological threshold. Silver re-rates from being cheap gold to a premier monetary asset. The gold-to-silver ratio likely collapses toward 31, but this brings us to the most critical question: when do you exit? The answer is counterintuitive. You do not sell silver for dollars. If silver is at $100, it means the dollar is failing. Selling your scarce asset for a dying currency is a mistake. Instead, you must use a swap strategy. The first option is the gold swap, when the gold-to-silver ratio drops below 30, meaning it takes 30 ounces of silver to buy 1 ounce of gold. You trade your volatile silver for stable gold. This locks in your purchasing power gains in a Tier 1 asset that is less prone to wild swings. The second, and perhaps ultimate option, is the asset swap. You wait for the ratio between silver and real assets to return to historical norms. In 1980, you could trade roughly 800 ounces of silver for the average American home. When that ratio returns, when a monster box of silver can buy a house or a business or a tract of land, that is when you exit. You move from defensive wealth, silver, to productive wealth, income-generating assets. Friends, the window is boarded up. The supply chain has snapped. We have crossed the event horizon. The chaos we are seeing is the market desperately trying to find equilibrium in a world where the physical buffer is gone. $62.30 is not a peak. It is the floor of a new reality. If you found this analysis valuable and want to stay ahead of this unfolding crisis, please like this video and subscribe to the channel. It helps us get this truth out to more people. Hold the line, ignore the paper price, and prepare for the greatest wealth transfer in history. Thank you.